Welcome back, options traders. Happy Wednesday to everyone. And this will probably be the last video for this week as I have a big event, an options event in Miami. So looking forward to that, but hopefully getting back on track next week. But in the meantime, another great question came from one of the traders in our group. The question is, can an at-the-money option beat an in-the-money option? And what he meant by this is in terms of total dollars. So I think everybody knows in terms of percentages, yes, at the monies and out of the monies can certainly outperform in percentage terms because of the leverage. But the question is, can the at the monies ever beat the in the monies in terms of total dollars? Fabulous question. You've probably heard me in some previous videos where I've said the in the monies have greater deltas, they have less extrinsic value, and so therefore they will always have greater profits in terms of dollars. But his question is, under what conditions could the at-the-money option win, if there are any? So it just depends on how far you want to stretch reality, but the answer is yes, it could happen. Let's go find out how. As always, before we do, please be sure to click like and subscribe. It's greatly appreciated and helps so much to promote the channel. Okay, so this is going to take a little bit of mathematical notation. I'm going to take it slow, so try to just follow along here. So we're looking at the profit for an at-the-money option, and we're going to look at expiration. So it's going to be the stock minus the exercise price of the at-the-money, and then we're going to subtract the cost of the at-the-money. So what this is telling us is what's the intrinsic value, what's the difference between the stock and the exercise price, and we subtract out the cost, and that's going to be the profit. So now we're going to do the same thing for an in the money. An in the money is worth at expiration the stock price minus the exercise price or the strike price of the in the money. That's the intrinsic value. And then we're going to subtract off the cost of the in the money strike. I'm just going to use calls in this example. So these are the at the money calls versus the in the monies. And so what we're trying to do now is to look at this difference. We want to see if ATM minus ITM could ever be positive. So now what we have to do is we have to subtract this bottom equation from the first. We're going to take everything in this top row, subtract off the second. So starting from the left, ATM minus ITM is ATM minus ITM. Then we're going to say it equals stock minus the stock, and that just cancels out. So that goes to 0. And then we have a negative exercise price minus a negative exercise price, which makes this a positive. You kind of got to keep your bearings when you do this. So it turns out that the exercise price of the in the money is positive minus the exercise price of the at the money. And then over here we take the cost of the at the money minus the cost of the in the money. So again, subtracting a negative is going to make it a positive. So this becomes a positive cost of the in the money right there minus the cost of the at the money. Okay, so now that we've got kind of a mathematical formula here, we can gain some insights. Take a look at this. If we look at the exercise price for the in the money minus the exercise price for the at the money, we always have to get a negative number or less than 0. Because we know, if we're using calls, that the in the money calls have to be a lower strike. So maybe this is the 95 call minus the 100 call for the at the money. 95 minus 100 is minus 5, which is less than 0. So that's always going to be less than 0. But look over here to the right. What about the cost? The cost of the in the money will always be greater than the cost of the at the money because it has intrinsic value, this in the money option. So it's always going to be more valuable. So we know that the cost of the in the money minus the cost of the at the money has to be greater than 0. So now we get an interesting relationship here. It's a tug of war. In order for the at the money minus the in the money to be positive, in other words, that the at the money option beats it, that we can't have, let's say, minus 5 and plus 5. They would just cancel. So what we need in order for the at the money minus the in the money to be positive, in other words, greater than 0, the only way for that to happen is that the difference in these costs right here must be greater than the difference in the strikes. And that means that this positive number is bigger than this negative number, and therefore we're going to have a positive number over here, which again means the at the money option beat the in the money. So could this ever happen? Well, let's look at an example. We'll use the in the money, let's say, is the $95 call, and the at the money is the 100 call. If we take 95 minus 100, we get minus 5. Let's say that the in the money call is trading for 7, and the at the money is trading for 4. Now we have 7 minus 4 is 3, positive 3. And now we can see that if we take the at the money minus the in the money, it's always going to be $2 behind. The at the money will always lose by 2. So for example, let's say the stock is 110 at expiration. The $95 call is worth $15 of intrinsic value, right? With a stock at 110, it's got $15 of intrinsic value. But we paid 7. So 15 minus 7 is 8. That option would be trading for 8 at expiration. Now what about the 100 at the money call? Well, with the stock at 110, the 100 call is worth 10, but we paid 4, and so it would be worth 6 at expiration. And now you can see that the in the money is $2 greater than the at the money. Or in other words, at the money minus in the money is -2. And that's what we're seeing here. And that will always be true. The at the money will always lose to the in the money by exactly $2 at expiration. And that's because of this difference right here. We have a $5 difference in the strikes, but we have only a $3 difference in the prices. Okay, so under what condition could this happen where the at the money beats the in the money? Well, hopefully you see the answer right now is that the difference in these prices right here would have to be greater than 5. So let's try one. Let's say, remember we've got the 95 call, the at the money is 100, 95 minus 100 is minus 5. That's what we saw before. But let's make the cost of the in the money option 7. So it has $5 of intrinsic value, but it still has $2 of extrinsic value. And that could certainly happen. Either a lot of time remains or it's a high volatility stock. But if that's true, the at the money should have a lot of extrinsic value. But let's say it's trading only for 1. Well, now 7 minus 1 is 6. And see, now we see that the difference in the prices, 6, is greater than the difference in strikes. And so now the at the money will beat the in the money by $1. So for example, let's go back and put our stock at 110. The $95 call at expiration is worth $15 of intrinsic value. We paid 7. What we saw before, it's worth 8 at expiration. But the $100 call is worth 10 with the stock at 110, but you only paid $1 for it, so it's worth 9 at expiration. And now we see that the at the money minus the in the money is ahead by $1. 9 minus 8. The at the money is ahead by $1. But the only way for that to happen is that the difference in their prices would have to be greater than the difference in strikes. So now the question is, could this ever happen? Well, again, it's how far do you want to stretch reality? If the difference in prices is greater than the difference in strikes, the at the money will beat the in the money in terms of profits, in terms of total dollars. However, this is an arbitrage. We've talked about this in our pricing principles, that the difference in prices cannot exceed the difference in strikes. And that's why it's an arbitrage. That's why it's a pricing principle. So again, to answer the question, under what conditions could the at the monies beat the in the monies? It would have to be right here, that the difference in the prices of these options would have to be greater than the difference in strikes. However, because that's an arbitrage, don't expect to see it happen. In the event that that ever did happen, the AlgoBots are going to be all over that long before you can even hit the keyboard to send an order. So again, it's an interesting question, but just don't expect it to ever happen. If you're buying it at the money, it will always underperform an in the money in terms of total dollars. And that's something else to think about when you're setting up your strategies. And for anyone who'd like to learn more about the art and science of options trading, please check out the Alpha Trader course, Strategy Lab, and a Candlesticks and Technical Analysis course. It's all at optionsatoz.com. Also, please join us on Options A to Z's Facebook trading group, and you can find a link in the description below.